Hey everyone, welcome back to Corporate Decoder. Today, HWH International Inc. just filed its quarterly report for March 2026, and I am seeing one massive red flag that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is showing serious signs of struggle with its revenue diving and a clear risk of not being able to keep its doors open. We are looking at HWH International Inc.'s quarterly report on Form 10Q for the period ending the 31st of March 2026. Let's jump right into the financial tables. If we look at the balance sheets for the 31st of March 2026, total assets stand at about $4.2 million. That is down from over $4.5 million at the end of 2025. Their cash position took a hit, falling from about $2.1 million at the end of last year to just $1.46 million by March 2026. That is a significant chunk of cash gone in just 3 months. On the other side of the ledger, liabilities have actually gone up. Total current liabilities are now over $1.5 million, an increase from about $1.28 million at the end of 2025. Now, let's look at how they are actually making or losing money. The income statement for the 3 months ending the 31st of March 2026 shows a stark picture. Revenue has dramatically dropped. For the first quarter of 2026, revenue was just $64,200. Compare that to nearly $300,000 in the same period last year. That is a massive fall off. Their cost of revenue also dropped significantly, but not enough to offset the revenue decline. They spent about $16,900 on costs for the quarter. This led to a very small gross profit of just $47,288 for the quarter. The real killer here is their operating expenses, especially general and administrative costs. These were a staggering $672,202 for the quarter. That is almost 10 times their total revenue. And because of this, the company posted a net loss of over $626,000 for just 3 months. This follows a net loss of over $574,000 in the same period last year. Breaking that down further, the net loss attributable to common stockholders was over $626,000 in 2026, compared to over $565,000 in 2025. A clear increase in losses. Interestingly, the number of outstanding shares has increased quite a bit, from about 6.4 million shares in early 2025 to over 7.4 million shares by March 2026. This dilutes any potential profits for existing shareholders. Looking at the changes in stockholders' equity, we see a significant negative position. Their accumulated deficit, which is basically the total losses over time, has grown to a massive $9.57 million by March 2026. The cash flow statement really hammers home the going concern risk. For the first 3 months of 2026, they used over $192,000 just to keep the lights on in their operations. That is better than last year's burn of over $555,000, but it is still a lot of money bleeding out. Their investing activities also consumed cash, with over $305,000 used in the first quarter of 2026, mainly for convertible notes and marketable securities. Financing activities were negative by over $148,000 in 2026. This shows they are not bringing in significant new capital to cover their losses. This section is where the company directly addresses the elephant in the room. They state that the net loss, operating loss, and negative cash flow raise substantial doubt about their ability to continue as a going concern. They say they believe they have enough cash and support to last at least 12 months. But this is a very cautious statement. They are pinning their hopes on cash from operations, which is currently negative, and financing from related parties. This quote is critical. Their majority stockholder, Alset Inc., has promised to provide funding and not ask for repayment for a year. This is a lifeline, but it is not a guarantee of future success. They are essentially relying on their parent company to keep them afloat. Now, let's talk about their stock price. The company notes they regained compliance with Nasdaq's minimum bid price requirement of $1 after a 1-for-5 reverse stock split earlier in 2025. However, this is often a temporary fix. Many companies that conduct reverse splits to stay listed often face delisting again later. It is like putting a band-aid on a serious wound. This is a concerning part. They admit that their disclosure controls and procedures are not effective. This means they might not be reliably gathering and reporting important information to their management, including the CEO and CFO. This lack of control is a serious internal weakness. Looking at their business strategy, they're involved in food and beverage, and are trying to build out a marketplace called Happy Marketplace and an educational program called Happy Wealth Builder. Their food and beverage revenue has been the main source of income. But as we saw, it is shrinking dramatically. They mentioned closing down cafes in Singapore and Korea in late 2025. This clearly explains the revenue drop. It's also worth noting that for the first quarter of 2026, 5 suppliers accounted for nearly 60% of their cost of revenue. This concentration risk means they are very reliant on just a few key suppliers. If one of them has an issue, it could significantly disrupt their operations. Their financial numbers are quite alarming. When revenue falls this drastically and a company continues to burn cash on high operating expenses like general and administrative costs, it is a classic sign of a business in trouble. The fact that they have a going concern warning and a significant drop in revenue paints a very bleak picture. Now, for some slightly positive news, but with some major caveats, on May 5, 2026, they entered into a term sheet for a $10 million investment from Smart Dynamics Technology Limited. This would involve selling 20 million shares and warrants. The investor would also get significant control, including appointing 3 directors. This is a lifeline, but it comes with a lot of dilution for existing shareholders and significant investor influence. Also, on the positive side, they mutually agreed to terminate a planned acquisition of Happy Metaverse Inc. This likely saves them from further financial commitments they might not have been able to afford. Looking at the leadership, the report is signed by Chan Hung Fai, the CEO, and Rongguo Wei, the CFO. These are the people ultimately responsible for the company's financial health. So HWH International Inc. is in a very precarious position. Their revenue is plummeting, they are losing substantial amounts of money, and they are heavily reliant on last-minute deals and support from their major shareholder. The ineffective internal controls are also a big red flag. While the potential $10 million investment offers a glimmer of hope, it comes at a very high cost, likely involving significant dilution and loss of control for current shareholders. The risk of them not being able to continue as a going concern is very real, and history shows that many companies in this situation, especially small ones that do reverse splits, eventually go under. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like, comment, subscribe, and join our Discord.